Hello, my name is Cherie Jones. I am a director with the Texas Tax Credit Division of SwansonReed. Welcome to our webinar today. Thank you for spending some time with us to learn about cost segregation and utilizing federal and state R&D tax credits within the manufacturing industry. The R&D tax credits lower your tax obligation by claiming the qualified expenses you may already be incurring for new product development or expenditures for making improvements or modifying your existing platform of products and services. We'll spend the first 30 minutes today on R&D tax credits presented by SwansonReed. SwansonReed is a global R&D tax credit consulting firm. We assist companies with qualifying and accessing the financial benefits of federal and state-based research and development tax incentives. In the second half of our webinar, we will cover cost segregation for the manufacturing industry with Terri Johnson and Capstan Tax Strategies. Terri is the managing partner at Capstan Tax Strategies. Capstan collaborates with owners of real estate to identify tax savings opportunities related to tangible property and other fixed asset regulations. Terri is a subject matter expert in cost segregation and other tax incentives for real estate owners. Now, I would like to introduce SwansonReed's tax director, Mike Flesher. Mike is going to walk us through the R&D tax legislation. Then we will discuss the activities and expenses that qualify for the credit and explain how claiming these expenses can lower your tax obligations. By the way, there is a Q&A box in your top right-hand corner to submit questions, or you may simply click on the Ask a Question link at the top of your screen. We will answer as many questions as possible at the end of the webinar today. Mike, I'll turn the floor over to you now to educate us on how companies can now fully utilize this R&D legislation for long-term tax planning strategies.
Okay, thank you, Cherie, and good afternoon, everyone. As Cherie said, my name is Mike Flesher. What we're going to do in about the next 15-20 minutes, we're going to run through some of the basic rules of the R&D legislation, as well at the end we're going to do some real simple calculations so you can assess whether this will be something beneficial to your company. The R&D legislation was first passed in 1981 under President Ronald Reagan as part of the Economic Recovery Act. Its intent was to provide a tax incentive for people to do research and development because that is good for the country. It results in a credit to a tax return, and as everyone should know, a credit is worth a lot more than a deduction. In a deduction, you only get just a percentage of an expense back in real dollars. In the case of a credit, though, you get 100% back, the full dollar back. So it has a major bottom line impact. Okay, who is eligible? Everyone is eligible who can pass the IRS's four-part test that we will talk about on the next slide, go into just a little bit more details on that. And if we can substantiate and document our QRE, our qualified research expenses, we have had companies as diverse as people working on different metals for motorcycle mufflers, all the way up to working on throughput method changes for chocolate candy. So there are no limitations on who can qualify as long as they can pass the IRS's four-part test. Speaking of which, these are the four key components to it. The first one is by far the most important. R&D has to be technological in nature, and that means that it is something to do with mathematics, engineering, computer science, or something with earth and natural sciences, as in the case of say, coming up with new metals that have got new tolerance levels or new specifications. This automatically normally includes processes of experimentation. Any kind of testing, there's normally trial and error testing, there's expenses incurred, and as long as those expenses are for legitimate reasons, not trying to manipulate data, they will count even if the testing is unsuccessful. The third and fourth items here are should be apparent by their definition what they mean. Technical uncertainty means that there is something that we're having a problem with and we're trying to improve it. That's kind of self-explanatory, as well as a permitted purpose means that we have an objective, something that we're trying to improve to make our processes run better. So as long as a company can pass this four-part test, they can qualify for the research and development credit. Okay, again, R&D does not have to be successful. Trial and error, by definition, involves mistakes. There's going to be failures. But as long as there's not any kind of indication that data is just being manipulated to get a credit, the IRS will allow those expenses. Okay, there's three major components at arriving at an R&D credit as outlined here. Payroll, supplies, contracted research expenses. And we're going to go into each one of these in just a little bit more detail to give you an idea of what forms them. The first one being payroll. And this is by the biggest component in most R&D claims. This is payroll for bona fide employees. In other words, employees who receive W-2 forms to you, not from temporary help or contracted people. It's bona fide employees. And we can count the payroll of employees engaged in R&D who are involved in the direct R&D on the actual line. They're actually doing hands-on work with the R&D. We can also count their direct line supervisors. In other words, just one echelon above the person doing the R&D. Cannot go any higher than that. Cannot go like second echelon or a payroll department or someone in administration in a plant or an operation. It has to be the actual employees, direct line supervisors, and then also this third category of people who directly support the qualified research efforts. And we will assist when an employee has got mixed duties, so they do some R&D and then some other things in the operation. We'll have to put a weight on their salary. So if they spend 60% of their time doing R&D, we'll count 60% of their gross salary towards the QRE, and the other 40% will not count. Okay, second major category is supplies. Expendable supplies are items that are totally consumed in an R&D project. Those are the easiest ones to claim because they are used up. They are not there when they get finished with the process. Durable equipment can be counted, but it has to be durable equipment that has no resale value and is typically scrapped after the R&D project. When you get a case of where the equipment is bought outright in order to pay 100% of the cost initially, we can count that 100% in the that particular tax year. But when it's paid out like on credit, we count the principal payments in that particular tax year. An example of what would not qualify would be like a computer, because it could be used in an R&D project for perhaps a year, and then it's given to someone in administration to use after that. So see, it's not a totally R&D piece of property, so it would not be counted. Okay, third major category is contracted research expenses. 65% of those are allowed by the IRS, and this has to be for bona fide research also. It cannot be for a conventional service such as having an electrician come out and rewire some of your equipment. Okay, there's certain exclusions, things that can't count, and I'll just, you can read this list yourself, and I'll just highlight on a couple of main ones. The first one, the fifth one, and the sixth one are pretty important because they apply to everybody. Research and development ends when normal production starts. In other words, by definition, normal production is when you've worked out all the bugs and you're just doing a routine process over and over again. So R&D does not exist after you begin normal production. The fifth item down, foreign research, if it's done outside the United States, it does not count, because remember, the intent of the legislation is to encourage R&D within the United States. We had a case recently where somebody was outsourcing work to China, and they were insistent on counting those expenses, but the actual R&D was done outside the U.S., so it could not be allowed. We did not use it. And then the sixth bullet, the research related to social science, arts, and humanities are disqualified because, like I said at the beginning of the briefing, this is a technology-based credit. It has nothing to do with liberal arts. Okay, returns can be amended to where you can go back 3 years to claim your R&D credits that far back. The normal rules of amending apply. And if you're not certain on those, your normal tax preparer can explain them to you. There's some nuances based on whether you filed before your initial filing date or whether you're filing on an extension beyond that date that apply. But from whichever date is applicable, roughly 3 years back, is when you can claim credits from that point to the present and recover credits in that area. Just as a word of caution, amending a return opens that return for full scrutiny by the IRS into any areas. So if there's something that you just barely got by on at the time when the initial return was filed and you really don't want the IRS to have a second look at it, it might not be a good idea to amend that return. Okay, carry forward, carry back. R&D credits are ordinary or general business credits, I think is how the IRS terms it. If you want to see this in writing, you can go to the instructions for IRS Form 3800 on page 1, second column, about the third paragraph down. It defines that you can carry credits forward for 20 years and then back 1 year. And so anyhow, there's things to determine whether you want to carry forward or carry back based on what your situation is at the time the credit is earned, which year you're in. There may be other factors that you don't want to use it at that time, and it's better to carry it forward, and those are all items that primarily your tax preparer can assist us with on that, but those kind of decisions need to be made at some point. But that feature does exist for us to use. Miscellaneous rules, just go over a couple of things, don't fit in any other categories. Reverse engineering is using somebody else's engineering. Can't claim that, as well as credit that might have been claimed somewhere else. It likely could have been claimed in a subdivision of your organization. If it's been claimed once, you can't claim it twice. And then the third item, R&D has to be performed in the United States. And when we get into state claims, that same mindset applies. If you're located in Texas and you're filing a Texas claim, the R&D has to be conducted in Texas, not in Missouri or somewhere else. Okay, if you work through a university, there is a special credit you can get on that. It says on this slide 20%, but there are some calculations that are performed before you get to taking that 20%, and we'll go through them with you at the time if that applies to you. If it does apply, it is better than what you get under the normal process. Okay, Texas. Texas provides R&D credits. Now you get a choice. You can either file the credit against your franchise tax, actually, to be more specifically, up to 50% of your franchise tax, or you can take an exemption from the sales and use tax. Now, what would guide your decision on this is, for example, let's assume that you're buying a lot of equipment and you're going to have very large sales and use taxes to pay. So it might be more advantageous to take an exemption from the sales and use tax. Under most circumstances, people elect to take the credit against the franchise tax, actually up to 50% of it. The Texas claim, at least, other states are a little bit different, but the Texas claim, at least, you can lift almost the same data off the federal return and use it in the Texas return. So effectively, you can get 2 credits for the price of 1 as far as hits on your time go. So we won't have to come back and collect additional data to do that. Okay, let's work through just a couple of real simple examples just to give you an idea how the system works. First of all, first bullet, you've got to estimate your QRE. Now, we'll do that with you for free, and we'll help you determine whether this is advantageous for you to pursue. We're going to be asking you for your payroll, your supplies, and your contractor research expenses, and they form the base or the core of the calculations. Now, the first 3 years that you attempt to make your claim, you use a very simple method. We total up your total QRE. In the case on this slide here, this example on the slide, it's $10,000. The IRS uses a 6% rate. You can see that on a form 6765. It's IRS form 6765. They apply a 6% rate of that to determine your gross credit. Then there is a thing called a 280C election. You can see on this slide, it's on form 6765, it's IRS form, line 34. I'm using 65% in this example, but when we go to the next slide, let me explain a little bit more about this 280C election. And I want to make a point too. This is something you don't have to do. We'll do it for you. We may ask you some questions. We'll let you know what's happening, but we'll help you derive at the correct decision on that. But in this case, we apply 65% to that $600 and come up with a net credit benefit of $390. Again, you will get back 100% of that because it is a credit. It's not a deduction. Okay, the 280C election. This will apply to all claims you make, amended, current, past, present, future. There's a decision that has to be made. You look on line 34, as mentioned earlier, and you got a yes or a no to pick. For amended returns, you'll always pick no, and you will multiply your credit times 100%. That's outlined in the second bullet on this slide. The reason for that is that the expenses you're claiming as research expenses were already claimed as ordinary business expenses. The amended returns have a feature or a mechanism in them where they will back those expenses out so that you don't count them twice when you take a credit. So you could take 100% of the credit, and then the amending process will remove those expenses from your ordinary business expense line so they are not counted twice, so you won't be double dipping. On the other hand, when you file an original return, a current year return, that does not happen. So you'll have the same expenses, let's say payroll, in your ordinary business expense section, and then you're also repeating them back in your R&D claim, the same people. Well, the IRS is not going to let us get away with that, and therefore the IRS has picked an arbitrary rate of 65% because that's the inverse of a typical tax rate for business, 35%, and they'll let you take 65% of the credits on current year returns or returns for where you've never made that election in the past. So when you get to line 34 for the initial year return, you'll pick yes, and you'll use 65%. Again, let me repeat, we will walk you through that process. We'll help you make the right determination on that when we get to it. Now, let's go to a case where you have filed 3 consecutive years of R&D claims. Here's an example. We'll go through it one step at a time. You can see 5 lines there, 1, 2, 3, 4, 5. Line 1 outlines some example QRE you had in the past. As you can tell, 11, 12, 13 years. We're actually filing them for 2014. These are the 3 years preceding that. In this case, they totaled $30,000. The IRS has us take an average of that $30,000, looking now on line 2, take an average of that $30,000, dividing by 3 years, and then a mean of that divided by 2. 3 times 2 is 6, so you can just divide by 6, and you get what's called a base amount of $5,000. Again, I'm looking on line 2. You take that base amount and subtract it from your current year QRE, and in this case on line 3, we're assuming a current year QRE of $20,000. We reduce that by the $5,000 base amount and get a $15,000 eligible QRE for the current year. Now line 4, that $15,000 is multiplied times 14% equals $2,100. Line 5, it's a current year return, so we have to use a 280C election of 65% times that $2,100 to arrive at a gross credit of $1,365. Again, we'll do those calculations for you, but the reason I wanted to walk through this one with you is because it is sometimes misleading to say, oh, the first 3 years we use 6%, 4th year we can use 14%, and that sounds like a big jump. But when you realize that the methodology of calculating your eligible QRE changes dramatically, the 14% is still advantageous to the 6%, but not as much as it might just appear on the surface. Okay, we've done a couple of examples, and we talked through some of the basics of the R&D legislation. And again, as Cherie mentioned earlier, we've got a Q&A session here. If you want to enter questions, we'll be glad to answer them with you, go back to you. We work through most of this with you for free until we get up to the point we determine whether it's eligible to go ahead and pursue filing for credit. So we will leave that for your decision and whether you want to get back with us or not. Okay, at this point, let me turn this back to Cherie. She's going to go through some activities, which are some case situations that we've had recently with R&D, just to bring you up to date on that. Thank you very much. And Cherie, you'll make those additional comments.
Thanks, Mike. Let's take a minute to look at some of the most common activities that we've seen within the manufacturing industry that qualify for the R&D credit. developing second generation or improved products, designing and developing better cost-effective and innovative operational processes, the work that you're doing to streamline your manufacturing process through automation, any compliance activities to meet the ever-changing emission laws and regulations, the energy efficiency improvements you might be making to your plant or your manufacturing facility, increasing the energy efficiency of your fuel, your water, your utilities through energy efficient lighting and other various new technologies. I know that many of you are probably converting waste to energy. That would be a qualifying activity. And integrating new materials to improve your overall product performance and the efficiency of your manufacturing processes. And the types of documentation that you want to start keeping or be aware of. This is just a few of the types of documentation that we can use to substantiate your R&D tax credit claim. Project records, if you keep an annual innovation log of product changes, testing protocols, the results and the records of the analysis of those trial runs and the testing that you're doing, resource allocation, usage logs, staff timesheets. Also, if you keep regular meeting minute notes, that is an excellent documentation. If you don't already do that, we suggest that you might start recording the results of your meetings. Tax invoices, receipts. Once again, just everything is customized based upon the manufacturing facility that we're working with. These are just some of the items that we use to substantiate your claim. Now, before we move along to the cost segregation portion, I did see a couple of questions come in that I'd like to take a moment to address right now. They're R&D related questions. First question, this is an excellent question. Can the R&D tax credit be sold? Now, there are some states that offer the ability to sell your R&D tax credits, but the federal credit and the Texas state-based R&D credit cannot be transferred or sold. The tax credit must be taken by the company that incurs the qualified labor and supplies expenditures. And this is a follow-up question, also a great question, follow-up to what Mike was sharing with us on the financial aspect. Is there a greater financial benefit for increasing R&D activity and expenditures? Yes. After filing 3 consecutive R&D tax credit claims, your business will establish a 3-year baseline, which affords the opportunity to increase that 6% federal tax credit Mike mentioned to 14% on all qualified expenses in that 4th year that are above that 3-year baseline you have established. So under the federal R&D legislation, you are able to retroactively claim the last 3 years of qualifying expenses. So you can really establish that very important baseline quickly and begin earning that higher credit on your future research expenses. Now it's time to move along to the cost segregation portion of our webinar today. Terri, please educate us on how we may incorporate cost segregation into our tax planning strategies.
Thanks, Cherie. It's a great opportunity to be here today, and we're going to be talking a little bit about cost segregation and how that impacts you if you, I know a lot of people on this call have manufacturing facilities, so sometimes you own the facility, and then other times you're leasing a facility, but you've spent a lot of money fitting that out, so you actually own the fit out. So we can really do cost segregation on both of those opportunities. So what we want to do today is in a short period of time, is just give you a brief overview of the benefits of cost segregation. Then I'm going to kind of walk through some examples of qualifying assets. And then I'd like to also just update you on some recent developments that add value to doing cost segregation. And then we'll end with a case study. And if there's any questions, I'll be happy to take those at the end. Okay, here we go. So a cost segregation study is really a study that supports accelerating depreciation. So what does that mean? I mean, typically, if you have a manufacturing facility where your offices are in the manufacturing facility, or you have multiple buildings with you know, within your portfolio, you're going to depreciate that asset over 39 years. So what the IRS allows you to do is for certain assets to actually accelerate into faster lives. And what we do when we do a cost seg is we're basically giving you the documentation to allow you to do that. And why would someone do this? Well, if you accelerate depreciation out of that 39-year bucket, you're going to basically get a tax deferral and increased cash flow. So this is quite helpful for folks that are trying to offset income. So if you've got, you know, a profitable business, this is a way to offset income. So we talked about the 39-year life. So what happens when we're doing a cost segregation study is we're basically moving out of that 39-year into land improvements, which are you depreciate over 15 years, or tangible personal property, which is 5 or 7 years. Typically, in a manufacturing environment, the personal tangible property is going to be a 7-year asset. And I'm going to show you some examples of what that means, but I just kind of wanted to go over with you big picture when we're looking at the 39-year. What is that? It's basically what we call the base building, or the core and shell. So, you know, you construct a building or you buy a building, and the base structure, the foundation, roof, walls, windows, vertical transportation, if it's more than a couple stories, is going to be the 39-year asset. But how you fit out that building to the special nature of your business, a lot of that ends up being 7-year assets. And then you can imagine if you've got, you know, parking lots and outside and land improvements, you're going to have, we can move that into 15 years. Now, one of the things I want to caution you is that we don't depreciate land, obviously. So if you were to call me with an opportunity, one of the first questions I'm going to ask is, well, what are you taking out for land out of the basis? Because we just take that off the top. So at the end of the day, the real advantage of doing this cost segregation study to support accelerating depreciation is that it's all about the time value of money. You're not increasing your depreciation, you're literally moving it forward. So it's a you know, time value of money proposition. Would you rather have that money today or over a longer period of time? Now, some of the benefits of a cost seg is that, you know, obviously if you're going to do this, you want to be, if you were ever audited, you want to be in a position that you wouldn't have an issue with the IRS. So this is a recognized procedure by the IRS, and it's defensible. So you would use the cost seg study to maximize and support accelerating that depreciation. And obviously, if you ever got audited, that you'd have that study to back up what you have done and the positions that you've taken. And as I mentioned, you're going to also be increasing your cash flow. So that's the main thing, is the time value of money. But I want to bring up another point, and that is it's also an excellent asset management tool, because as you own that asset and moving forward, you're spending money on the building and the facilities. And let's say that you replace a boiler, and you need to write off the boiler that is there and it still has some basis left in it. Well, you can go back to your report and see what we valued that boiler at, you know, reduce the amount that you've already taken as depreciation and actually write off the remaining balance in the current year. So this report will it has a pretty long shelf life, because it basically sets you up with all the data that you need, not only to accelerate depreciation, but also if you're wanting to continue to invest in the property and maybe potentially writing off assets in the future, you could use it in that way as well. So when should you perform a cost seg study? I mean, the best time, obviously, is immediately after you acquire a building or you do construction. And we see a lot in a manufacturing environment. Let's say that you buy a building, but then you immediately start renovating that to the specific needs of your business. So we see that a lot. Or we see a new construction where you're building a building from scratch, ground up development of a new facility. We also see instances where you might be making major capital improvements, whether you lease the building or you own the building, maybe for a really long time, and you're putting on an addition or major capital improvements, and it's enough that it would benefit doing the COSSAC on that capital improvement project. Sometimes people forget that if you have a change in ownership, let's say you've got a family business, and you've got, or partners even, and you've got a partner moving out of the business and somebody buying their partnership out. That's a change of ownership. And from an IRS perspective, we have what we call a step up in basis. So it's almost like you have a new asset, and oftentimes it's enough. Let's say you have a 50% partner, it would be enough to do a COSSAC on that step up in basis. So let's say you had a $10 million building and someone buys out the other partner for $5 million. That's a pretty nice size basis that you could go in and do that. The other thing that we look at are buildings that are already placed into service. And you might say, how do you do that? And it's kind of an amazing thing to me that the IRS actually allows you to go back in time as if you had done the cost segregation study from day one and used this accelerated method. You catch up in the current year as if you had done it from day one. So let's say that you bought the property or built it in 2010, and now we're sitting here in 2016. So you decide today to do the COSSAC study. So all that accelerated depreciation that you would have gotten between 2010 and 2016, we catch that up in the current year, and we get all of that in the current year, and it's line 481A. It's a 481A adjustment, so that's the line on your tax return, and all you have to do is file a special form called a 3115 change in accounting method, which is presumptive approval from the IRS, and it allows you to change the accounting method, and you do not have to get permission, nor do you have to pay for that. So the change with the IRS, I mean. So we see these, probably about half the studies we do are look-back studies, and where you're going back in time, or it might even be, let's say, same example, you purchased a facility in 2010, and now you've decided to put a big addition on. You never did a COSSAC study before, so now you say, okay, we're going to do a COSSAC, but we can do the COSSAC on the entire thing. So you'd have different dates of service, but we would look at the old piece and the new piece in the same study. So there's a tremendous first-year savings potential in that scenario. So I like this slide because we work with a lot of different kinds of clients with different types of properties. Obviously here I've highlighted the manufacturing, but you probably can say, why is there such a big range between the amount that we could accelerate? So let's say you've got that $10 million facility that we were talking about, and we move, let's say scenario A, we're moving 30% of that into either 7 or 15 out of the 39-year bucket. So when would it be so much higher, say at 70%? And a lot of it depends. Remember what I was talking about, the special nature of what you do in your building. So the more specialized equipment, let's say you have some very specialized equipment, you've got electrical systems, HVAC systems, you have clean rooms, things like that that support the infrastructure that supports that. So most of those costs are going to end up being 7 years. And if you have a pretty big site, again, you could end up with maybe 20% in land improvements. So you can see if you have a really plain vanilla box manufacturing facility, fairly minor as far as operations, you're going to be on the lower end of that. Whereas if you have some very sophisticated equipment and all your support structure, you could be upwards of the 70%. So I think it really, as I say, it depends. It really depends on how you're fitting out that space. So let's talk for a minute about good candidates. Anyone that basically owns commercial property for whatever reason would be a good candidate for a cost segregation study, I'd say most of the ones that cross my desk are usually valued at least $2.5 million. But there are times, I mean, I've looked at a few this week that were hovering around between 1 million and 1.8 million, and maybe they own a couple properties that are fairly close together, and it makes sense. So it's really a matter of how much specialty equipment is in those buildings, because the more there is, kind of the lower the basis can be to get that value. I'd like to add here that we always present an estimate of benefit at no cost to our, if you're interested in taking a look. And it's conservative. It's a conservative estimate, but it would at least give you a feel of, is it worth pursuing? Another good candidate is any taxpayers that acquire, renovate, or improve real estate on a regular basis. And when I was talking about the look-back opportunities, you can actually go back as far as '87. But I think by then you pretty much fully depreciated that asset. So unless you've had a lot of renovations or big improvements since that time, probably not worthwhile. I'd say the sweet spot is 10 to 12 years, something like that. And then renovation projects can be very specialized. So it's not unusual for us to even look at a renovation project as low as $200,000. But what if a lot of that is special purpose, and so it might be a big percentage move into 7 years. So we would look at the facts and circumstances on that to give you a feel if it makes sense. So anybody that's regularly updating their facilities or putting new lines in and things like that, I mean, obviously somebody that's interested, that's working with SwansonReed on R&D tax credits and always innovating, you've got to design your facilities once you go to production. So you kind of look at that as, if you're doing innovating, you probably are changing your facilities as well on a regular basis. The other thing is, folks that have never performed cost segregation studies, there's some broader benefits that I'm going to talk about in a few minutes based on some regulations that have come down in recent times. So there's some basic information that we require before, when we're taking a look at, as I mentioned, we will send you an estimate of benefit and a cost proposal and we don't charge for that. And we also have a questionnaire that we can fill out. So if you contact either Cherie or me, we'd be happy to email over to you what that questionnaire looks like, and then we can run with it from there. But typical information that we need is the client name, the entity name, and what the project name, whatever you refer to it as, the address of the property, the date that it was placed into service, and a basic description. Is it a manufacturing facility? It's 150,000 square feet. It's 2 stories. It's on 30 acres. That kind of thing would be, what kind of operations do you have there? And a lot of it, once I get the basic information, we also are really good at going in and doing some research on the internet to fill in the gaps. So there are 3 areas that I wanted to focus on, and we've mentioned these: acquisition, new construction, look back. And we basically need all that information at the top. But depending on what type of project it is, we need some specific information. So if it's an acquisition, and we would need, and you haven't done you're just placing it in service, you just acquired it, we would need a copy of your closing statement, and I also need to know how much you've allocated to land, because obviously, remember, I told you we pulled that land out, so we want to know how much you're going to allocate to land, so we wouldn't include that in the depreciable basis. For new construction, we're going to look at what we call the final AIA document. And for those of you that are scratching your head saying, what is an AIA? Whenever you are building something and you're making draw requests, there's a standard AIA, which is I think it's the Architects Institute of America. I have to double check that, but I think that's what that stands for. But they have basic forms that you have to follow when getting draw requests from the bank. So when the project's finished, they issue a final AIA. It would include all the costs by breakout of category, like electrical, mechanical, concrete, and then you would also have any change orders would be included on that. And then in addition to that, we would need to know what soft costs that you would include. And soft costs would be all the things like permitting and engineering and architects and those kinds of costs. We also like to see blueprints, but we don't need those until you've engaged us. We don't need them at the time of proposal. And the third area is those look-back studies that I mentioned to you. And all I really need is the most recent federal tax depreciation schedule, not the book, but the tax, because that is going to tell us, everything you've done as far as your fixed assets since day one. So we're going to want to look at if you've got this piece of real estate in a real estate company versus the operating company, we're going to need to see that. If you've also got some costs in the operating company as well, we would want to look at both depreciation schedules because there's information there in both cases. And just to give you guys a little feel of what kind of, when I say 7-year assets, what are we talking about? So here's a couple good examples where you see dedicated electrical or HVAC system. So we literally will go in and look at what electrical is needed just to run the building versus the special purpose nature of your electrical systems or HVAC systems, and we will go in and we segregate those costs out between 39 and 7 years. Or the other picture is modular clean rooms. Believe it or not, most of the spend right there is going to be going right to 7-year asset because it would be, in this particular picture, was easily moved. I also want to bring your attention on that right picture. The flooring is like a VCT type flooring, and it's that would be a 7-year versus if it was some other, like a concrete or something like that, it would not be. So it really depends on what type of flooring and those kind of the materials that are used as to whether they are 7 or 39 year. Obviously, office furniture and fixtures and things like that would also be 7-year classified. Now, the land improvements that we mentioned can be loading docks, large paving areas, fencing, roadways. Think about stormwater retention. A lot of that now is underneath the ground. You don't even see it, but it's very expensive. And if we know there's stormwater retention system that the owner owns and has put in maybe at either when you built it or when you've acquired it, we would be estimating the cost for that as well. And then you're always going to have these soft costs that I mentioned. And so whether you acquire it or it's new construction, we're going to allocate a portion of the basis to soft costs. And it's going to track by the percentages that you moved for your hard costs. So let's say you've moved 15% to 7 and 10% to 15 year, the land improvements, your soft costs are going to trail exactly in the same way by ratios. But if you have a specific soft cost, let's say you had a landscape architect for your landscaping, that would be a 15-year cost because you can identify and know that the landscaping is a 15-year cost. So that would be the only exception to that. Now I wanted to just talk about a couple of the recent developments that add value to a cost seg. So we've been doing cost segs for years on accelerating depreciation. And in addition, since 2001, we've seen almost on an annual basis these tax incentives that come out from the federal government to kind of keep the economy motivated and moving. And so we really take a look at that. And just to let you know, if you go back in time to say, let's say you went back, you built a building in 2012, and we were able to move 30% of that asset on a look back to shorter lives, you'd also be able to take bonus depreciation. Or in the current year, it's 50%. So what happens is pretty much every year, the government comes out with these new acts that tell us what the incentives are going to be for that year. So recently, we got what we call the PATH Act, and they extended bonus depreciation, which applies to 5, 7, 15-year assets, really anything under the 20-year maker's life. They extended 50% bonus retroactively for 2015, for 2016 and 2017, and then it drops to 40% in 2018 and 30% to 2019. Wow, this was incredible because it has been in the past, it's sort of like a year-by-year thing. All of a sudden we have a window moving forward that's really going to help you plan. If you've got some renovation or new construction projects that you want to do, you're going to be able to use this PATH Act to accelerate 50% of anything that's under 20 years. You can take half of that in the current year. So let's go back to the $10 million example. We build this new facility this year, and we move 30%. That's $3 million. And I can take half of that in as bonus depreciation. That's $1.5 million right off the top that I can take in bonus depreciation because I have moved those assets into shorter lives. We also offer what we call our depreciation accelerator that summarizes all these incentives by year since 2001, and it also includes, which I'm not going to get into detail on today, but things like qualified leasehold improvements, which were extended for permanently to be 15-year property. And there's certain rules around that. But I would like to just let you know that if you want a copy of this depreciation accelerator, please definitely feel free to email Cherie or me, and we would be so glad to send it over to you. And another development was the tangible property regulations that came out effective January 1st, 2014. I got to tell you, these are really complicated and hard to understand. We have spent a ton of time teaching our CPA clients about these and also folks like yourselves. But at the end of the day, what these regulations do is they basically look at when you're spending money on improvements on your facility, do I expense this spend or do I capitalize it on any of your tangible assets? So what we have, the research we've done and really spent time on this is there's a process that you follow in looking at whether you expense or capitalize. And again, I've got a nice little tool that we put together, a flow chart that kind of walks you through step by step of how to do this. Again, if it's something that you would like, just email me and say TPR, and I will send that over to you. And if there's enough interest, I would be happy to come back and do another little seminar on this particular topic. But for now, I just want to make sure everybody was aware that these regulations are out there. They can be very beneficial if you know what you're doing, and you end up probably expensing way more than you would have before just because you're using these regulations to your advantage. And how does that dovetail with the COSSAC? Well, we're giving you the data now in our COSSAC to help you have the data that you need to comply with these regulations and make it easier to take advantage of them. And that is included in your base cost segregation report now. And I promised you a case study. So this is one that we did in 2015. And what happened was a manufacturing company that placed their asset into service in 2001. So they'd owned it for a while. Business was good. So they put on this, if you can see in the first picture, in the forefront, that was actually a big addition. It just happens to match very nicely to the original building. So the total basis from the original acquisition and the big addition was $11 million. So what we did on this is we did a look back on the original cost seg, and we did a cost seg on the new piece. And we did these unit of property tables to comply with the tangible property regs as well. So the first year tax savings were $512,000. The 10-year net present value was a little bit more than that. It was $556,000. And you can see the percentages that we moved, close to 10% between 5 and 7 years, close to 20% to 15-year land improvements. And that doesn't even tell you the benefit that they're going to get long-term out of that report by having all the data that they need as they make improvements to the property going forward to be able to have the data they need to write things off or do their expensing. Okay, that was a lot of information in a really short period of time, but I did want to open it up for questions. And I see we've got one question here that is, two questions actually that have come in. The first question is, would we get any benefit out of a cost seg study if we are not profitable? I might be profitable in 2 years' time. So that's an interesting question because you can kind of go two ways with that. So I've never done a COSSAC because I haven't been, I've not been profitable, but I might be in the future. So the way I would look at that is one of two ways. One is that start right to end right. I'd like to go ahead and get everything set up, knowing that I'm probably going to be profitable in the near future, get my depreciation schedule set up correctly, have my unit of property data for the tangible property regs, and really kind of be set up knowing that I'm not going to take full advantage. Because you can, just as with the R&D tax credit, with these depreciation deductions, if you can't use them right away, you can move them forward and 20 years as well. So you can carry those losses forward for 20 years. The other school of thought would be, let's hold off. I don't really want to spend the money on this until I need it. So at that time, I can go back, do my COSSAC study, and it'll be a look back now. So I will get that catch-up depreciation as if I had done it from day one. The only additional expense I'm going to have is I'm going to have to pay my CPA firm to file a 3115 when they file my tax return to do that catch-up depreciation. That's really the only big change. So it's a kind of a decision as to, do you want to kind of start right to end right, or would you rather not spend the money until you need to? So you can go either way with that. I have a second question here. I have owned a property for 5 years, and I never heard of cost segregation. Is it too late to take advantage of it now? So I think that 5 years is kind of a sweet spot. I think you've got plenty of time in order to do a COSSAC study and really make it worthwhile for you. But I think you want to make sure, do you need the deductions? Obviously, if you are making money and you've got income that you're trying to offset, it could be a really great tax planning tool for you to use at this time. And then if you can't use all the deductions, you can carry those forward, as we mentioned. So we would be doing the look back study for you, and on that's the one where I would just need to see that sort of the top part of those questions, as far as a little bit of information, the address and the name of the facility, and then I would need to see that tax depreciation schedule. And once I got that, I can give you an estimate of benefit and see if you think it makes sense to do that. I will tell you that my estimates can be a little conservative because I want to make sure you're just making a business decision based on a conservative estimate, but we typically beat the estimates that we put out there. Just want to try to give you an idea of what you could expect. Okay, I think that's all the questions that have come through. It's really been great having the opportunity to speak with you today on cost segs, and at this point, I'm going to turn it right back over to Cherie.
Thanks a lot, Terri. That was very informative and helpful. Now, Terri will send you that questionnaire to collect some basic information so that Capstan can provide an estimated financial benefit at no cost to your business. SwansonReed's next step to help you identify the qualifying labor activities and expenses your company is incurring now and has incurred over the last 3 years, and put a dollar amount on that financial benefit your company has already earned. So please take a moment. Oh, Mike, could you post our contact information slide again for everyone with my contact information and Terri Johnson's? Take a moment to jot down our contact information so that we can schedule a convenient time to speak or meet by phone. We would like to prepare an initial R&D tax credit study at no cost to your business. This initial study will help you determine what exactly the financial benefit is for your company in real dollars and cents. Then you and your CPA can decide if it's commercial and worth your time to take the next step in the claims process. I do see that we do have more questions, and I apologize, but we have run out of time. But Terri and I personally will follow up with each of you to answer the questions that we did not address, and just want to make sure our contact information is posted for everyone to jot down. Please don't hesitate to contact us with any additional questions that come up in the meantime. Thanks again for your time today. We'll look forward to helping you with a cost segregation study and help you identify the current activities that you're presently performing that qualify for the R&D tax credit. Then we'll prepare those initial studies at absolutely no cost to your business. We're always here to help. We truly appreciate your time today, and bye for now.